Hello, this is Dan Beniak from Treasury Partners Portfolio Management Group. We're back with another monthly update of what we've been seeing in fixed income markets. And the theme of the past month has been one of relative calmness. So, a lot of the volatility that we've been seeing in fixed income markets leading up to today has really started to calm down somewhat. In terms of what's going on in Treasury yields, we've been seeing some relatively stable trading ranges be established. 2-year Treasury yields on the front end of the curve, they're basically bouncing between 3.75% and 4% these days, whereas on the longer end of the curve, 10-year yields are between 4.25% and 4.5%, their own relatively tighter trading range. So although you can still see 5, 10 basis point moves on any given day, you've really seen things calm down compared to what was happening a couple months ago, where you could have seen 20 plus basis point moves and significant trends developing in either direction. In corporate credit markets, it's also been a calmer, less volatile environment. Corporate credit spreads, which is a measure of how much risk investors are building into risk assets, those have been coming in and according to some measures, are starting to look historically tight, which does indicate the fact that investors don't really seem to be building in a significant risk premium, don't think that there is really much of a near-term recession risk, and they're pricing their assets accordingly. In the muni market, long-term tax-exempt yields of 4.5% on 7 to 10-year, 20 to 30-year final maturity munis are still available at 4.5%, which is a significant after-tax rate. And one way that we want to highlight why we're seeing value in this is by comparing it to its alternative on the short end of the curve. So if you chose as an investor not to extend maturities and stay in shorter maturity munis or munis without a call option, you're basically giving up a lot of yield in this environment. So at this point, after a few months of grinding tighter yields on the front end of the muni curve, if you stayed with a 2-year AAA high quality muni, you'd only be getting approximately 2.5% for your money. If you extended a little bit and just went with a 10-year bullet, for example, which compares relatively closely to a 10-year callable long-term muni, you're not getting that much more than 3%, really less than 3.25%. So in exchange for taking on the call option on longer term munis, you're picking up 200, 225 basis points plus of additional tax exempt yield, which if we're talking about 4.5% munis for clients, depending on your tax rate, that's the equivalent of anywhere from 7 to 9% in taxable fixed income markets, which is far and away better than anything else that we're seeing in corporates or treasuries or agencies. So we still think it's a great opportunity, and we think that if anything, it's really just screaming even louder to us this day. So we're glad it's still around. We're taking advantage of it as aggressively as we can. And we'll be back here next month and recapping what we're seeing. Thank you for joining us.